let's delve into this extremely wide universe of asset-backed lending. That encompasses anything that finances hard assets, so plant equipment, planes, trains, buses, you name it, solar panels, through to financial assets, so receivables being among those that are extremely common, as well as intangible assets, royalties, whether it's music, film, or other media rights that can be financed, and emerging new activities like influencers. YouTubers get financed by private credit, and that's one of those things that are really exciting about this space. So what we'll do is to begin actually trying to survey this universe, and starting with you, Daniel. Maybe how do you look at this space, and what's in it, what's not in it? And in particular, how does that compare to the core private credit universe, which really is sort of sponsor-backed, cash flow-based lending?
Mm-hmm. Well, it's been quite extraordinary to witness the expansion of what private credit really is to that point. If you think about post-financial crisis, when private credit really started to take off, initially it was around doing the types of financings that the banks could no longer do, either because they were constrained due to regulatory issues, or they had suffered a lot of losses, so risk appetite. So it was rescue financing, distress financing. But that quickly evolved into the more traditional private credit market that we have still today. It's the biggest part of our business, direct lending and some opportunistic credit. And why did that grow so substantially? Well, because borrowers saw the benefits of private credit, certainty, speed, more flexible and customized financing solutions, and investors saw excess spread. So that's like the foundation for the growth in that market. And what's really been happening over the last 5+ years now has been this expansion into financing the real economy far beyond the leverage finance market. So if you think about the traditional market as being focused on leverage finance, non-investment grade, direct lending, the expansion is into all of asset-backed finance, which includes a huge investment grade component. So that's been a very big theme for us. We're talking about full capital structure investing now, and that's opened up opportunities with an entire new client base as well, especially insurance. But it's really broad. The other day I sat down with a client and they said, how do you define asset-backed finance? Because when we asked, they did a poll of managers, and they got 82 different asset classes. Okay, so I won't go through 82 different asset classes. But in all seriousness, for us, it's very, very big themes. At Blackstone, we're long-term thematic investors. We're talking about infrastructure broadly. We're talking about residential and consumer credit, commercial finance, transportation, fund finance. These are some very, very big categories where we envision deploying hundreds of billions of dollars in the coming decade. And what's really exciting to me is, again, coming back to your traditional world of private credit, even though it's still the biggest part of our business, it's about call it $2+ trillion market now. The addressable market for the broader asset-backed finance universe, we think, is $30+ trillion. So we're still in the very early innings. You think of direct lending as being phase one of what private credit can do. I think all of this is phase two and beyond. And to us, it's very exciting.
So a huge runway ahead of us.
A lot of runway.
Right. Kerry, how do you position yourself within this space?
Yeah. So I think very importantly, thank you for that, Daniel, because it is important that asset-based finance or asset-based lending represents a very broad category of underlying asset types and investment strategies. I think the capital formation and what you see as the more immediate investable opportunity has been overwhelmingly concentrated at the larger end of the market. So much more scalable platforms, investments into collateral pools such as consumer and mortgage, more granular assets that lend themselves to securitization. At the firm that I represent, Cheney Capital, we have really seen this as an extension of the mid-market corporate lending financing toolkit, where very specifically, what you have seen, and this is an important, I think, distinction from the preponderance of capital formation in private credit, it has been overwhelmingly oriented to corporate direct lending. And within corporate direct lending, more than 85% of deal volume, particularly in Europe, has been oriented towards financing private equity sponsor-backed firms and organizations. So predominantly leverage finance, LBO financing. So notwithstanding, I know Dan will talk about the investment grade private credit opportunity, but what we see particularly magnified in Europe is that this has left a very persistent and observable funding gap amongst SMEs, so lower core mid-market enterprises, particularly in asset-intensive sectors, because that is where bank retrenchment has been most acute.
Right, and with the sponsor back focused on a lot of the, let's say, less cyclical sectors, I guess that's anything that's more
Correct.
CapEx.
And there's been, very meaningful need for expansion CapEx, or indeed for a number of mid-market businesses that they need access to capital, asset-based lending, so bilateral private lending against hard physical assets, so equipment, mission-critical machinery, plant, and the like, provides them a way of unlocking liquidity and value from their balance sheets in order to fund their operations.
So you had a little more twist in terms of the definitional discussion, as in, corporate lending can be both sort of cash flow based, but also asset backed in nature. And but staying with you, maybe Kerry, how do investors, let's say, find their way in terms of, to you and your strategy? And again, how is that sort of complement the kind of the core cash flow based lending that they might be exposed to already?
Yeah, I think it is important to emphasize that asset-based lending, as Daniel quite rightly emphasized, it is a non-homogeneous asset class. It's a huge addressable market and opportunity. The way that our investors have particularly shown, I think, a very elevated level of interest in the asset class today is that they are looking for diversification from core private direct lending. And again, as I already mentioned, that is overwhelmingly dominated by sponsor-backed lending and also skewed to really upper mid-market, large cap. And so they are looking for other ways to diversify. That could be more opportunistic lending, non-sponsored lending, hybrid capital, junior capital. And they see asset-based lending as a downside protected, attractive source of, an alternative source of return streams, but capitalizing on fundamentally the same opportunity, which is European bank deleveraging and retrenchment.
I completely agree. I think that's been a huge topic, the diversification angle that you can get from asset-backed finance, because it's so much broader than the traditional corporate private credit market. And for us, it's been a lot about diversification also across the capital structure. I mentioned it briefly before, but if you think about our client base, one thing that has really attracted them to this space is the ability to also participate in private investment grade. If you think about the high yielding space and the traditional corporate credit related private credit market, generally speaking, the pickup versus liquid credit has been in the context of 150 to 200 basis points. What's been quite extraordinary for our investment grade focused clients is that in private investment grade, they have been picking up a similar premium, 150 to 200 basis points. And when you think about the absolute level of spreads, obviously spreads have been coming in across the entire capital structure throughout this year. Investment grade spreads are generally below 100 basis points. So if you're picking up 150 to 200 basis points beyond that for similarly rated versus corporates, it's just a massive pickup, and it's very diversified.
And how do you get to the investment grade? As in, is this always rated, or do you have internal criteria to define investment versus non-investment grade? And is it easier or more difficult in the different, let's say, subsectors of ABS to kind of make that distinction?
Yeah, so I should be clear that, when we talk about investment grade, it is proper investment grade, rated by the same rating agencies that rate the public deals. The big three and Kroll and DBRS are also quite involved. But there's really no basis there. And so it depends a little bit on the different asset classes, the rating methodologies that they have for those asset classes. Some asset classes, as Kerry was alluding to, are a bit newer, and you mentioned as well. I'm not sure there's a rating methodology for influencers yet. But in all seriousness, most of the asset classes, because of the hard asset nature, because of the quite predictable cash flow for most of the cash flow lend themselves very well to rating, call it 70 to 80% of most structures investment grade. And it's
Right.
literally the same criteria they would use for public credit.
Right. And
If I were to
yeah,
maybe
go
just
ahead.
chime in
Yeah.
on that too, I think again, we talk about why people are diversifying away from sort of sponsor-backed direct lending and that end of the market. Of course, there, the predominance of LBO financing, you are looking at a more levered capital structure where you are heavily reliant on the sponsor and indeed the management team to deliver growth in cash flows, to deliver on forecast synergies, to be able to deleverage the balance sheet and ultimately be able to refinance you at the back end of that facility. Of course, in the context of a lot of the asset-based lending, particularly where it is direct to the corporate as we participate in, but where these are amortizing facilities, and that amortization schedule is matched to the productive life of that asset. So these are revenue and income generating assets, which are essential to the borrower's ability to be able to generate earnings, and they typically amortize down to zero. And so they are self-liquidating in nature. So that provides a very attractive source of cash flow, as well as a sort of a very different risk profile. And I think that also lends itself. And I think another reason why investors are looking at the asset class is because historically they have exhibited significantly lower defaults and substantially higher recovery rates, given that structuring consideration.
Other than diversification, I mean, you talked about investment grade. Is there also investors seeking higher risks than, let's say, adjacent corporate credit?
Yeah, sure. I think that's, again, part of the beauty of this asset class, actually, is you can do anything from investment grade down to very opportunistic. And some of these assets, just given the nature of the cash flows, like very high quality resi mortgages, for example, they lend themselves to a lot of leverage if you want to put that leverage on. So we definitely see clients across our investor base, more on the institutional side than in insurance, but also participating much lower down in the capital structure.
Right. So what, if you were to think about some of the new developing ideas or markets, you said 30 trillion in addressable market. Where do you see sort of fascinating growth? What are you sort of looking forward to build, let's say, in the future, or compelling value?
Sure. Well, I'd say for us, we're long-term thematic investors. So we like to really pick areas where we think there's a mega trend happening, and we're going to be able to pursue it in multiple ways. I think the trend of all mega trends right now is everything around AI.
Right.
So for Blackstone, that has really been three big themes: data and data centers. We're a massive player in data centers globally, both on the equity side and on the debt side. It's been about power, because they take a lot of power, and chips. And so for us, those themes have been huge themes. And digital infrastructure basically is one of our biggest asset-based focuses right now. Again, actually, one thing that is in common with what Carrie was mentioning before is around how we do these financings. We're working with some of the best tech companies in the world, the biggest hyperscalers who are spending, the top 4 hyperscalers are spending roughly $400 billion this year alone on digital infrastructure. We're working with them. We're building these data centers together with them with long-dated, fully contracted cash flows. And when you do that, you end up with very high-quality investments. So for us, that's been one of the biggest trends, I'd say. Everything around AI. Obviously, it's much broader than that. I mentioned at the beginning how many asset classes there are, but that stands out in my mind, just given the sheer scale and also the durability of how long that opportunity is going to be around. I think we're, again, still quite early in that.
How about you, Carrie? Any themes within your strategy to focus on?
Yeah, I think there's a broader thematic. I'd be interested, Dan, what your thoughts are here too. But I think that's one which is, looking at the Europe and US side by side, similarly sized economies. But of course, in Europe, corporates rely on banks for more than 75% of their corporate funding needs. In the US, it's less than 20%. So you still have a very fragmented, less mature, less developed market that is serving the corporate fund, in terms of the corporate funding landscape. And I think so there's a lot further to go in Europe, particularly in our segment and what we're looking to achieve. I don't know if you see something similar in terms of that bank disintermediation opportunity being more magnified in Europe.
Yeah, I think there's often a lot of noise about are we friends or foes with the banks in private credit. My view is that we're doing more with the banks than ever before, actually, because we're connecting them with them more broadly. And the opportunity, actually, thanks to asset-backed, is very big with the banks because it's exactly as you just mentioned, the banks dominate Europe across these asset classes, and non-bank lenders don't play, especially in asset-backed finance, don't play a big role, and it's quite hard for them to actually establish themselves because the market is very fragmented. And so we have been working with the banks across all of these asset classes and across all of Europe. We have various partnerships. On the infrastructure side, we've done a large partnership, and we're working on a few more. I think infrastructure out of banks has been one of the biggest themes, actually, because there's so much need in Europe in particular for infrastructure spend, and the numbers are just staggering, so that they need additional capital. The themes that we're working with the banks, high level, are really, I'd say, threefold. The first is they want to optimize their origination, do more, rotate their balance sheet, and across all of asset-backed finance, really. And so we're helping them with that. The second is through the SRT market. That's where banks buy protection on performing portfolios. We're really active on that. That's, again, across all different types of asset classes, from corporate credit to infrastructure, resi, consumer, everything. And the third is around helping banks where they have, certain business lines that they'd like to pursue, but they can't. So our capital can be very effective because they have the relationships on the investment banking side, but they can't do certain transactions because of the risk tolerance or just their counterparty limits are full. And so that's been a huge opportunity for us as well. But I think you're right. There's just a huge amount still to do and come out of banks.
Right.
It is actually much more of a peaceful coexistence,
Yeah, exactly.
complementary, and which I think is distinct because, again, not to sort of beat the dead horse, but obviously to the extent that direct lending has been oriented towards upper mid-market, large cap, and competing head-on with the broadly syndicated loan market to provide credit, then the leverage finance departments at banks are feeling like endangered species in that regard. But when it comes to asset-based lending, again, where we're talking about that sort of strategic assets, equipment finance, we're really stepping in where the banks aren't prepared to lend. So the banks are still there. SME lending, though, they have their preferred products, which is receivables financing, very short duration. It is to some extent RCFs and inventory finance. Where they are doing equipment leasing, they're only doing very vanilla structures, very standard collateral types, but they really can't step in where it's a non-standard asset. By non-standard, I mean anything which is specialized equipment, second life equipment, in-use equipment. And the very distinction is that they're only looking to generate low, mid-single digit returns. So if we can step in and provide a customized solution in those situations, we're able to generate double-digit returns by virtue of being able to underwrite where the banks are just simply absent entirely.
So if I'm an investor looking to diversify my portfolio into asset-backed finance, what are the kinds of things that are different? We use origination as one of the defining dimensions of what private credit is. How is the origination channel important, especially if it's is it important to have a proprietary one? And how do you deal with risk management and monitoring, again, given that the sort of the sponsor relationship is generally absent? Right?
Do you want to start? Or,
As I said, we have really built our expertise and specialization in special situations in complex credit investing. That has meant that we've had an orientation and focus also towards non-sponsored lending. So there is no private equity sponsor that is providing the governance framework or the institutional controls. But that's where we're very happy to step in. So there are a whole host of really high quality, multi-generation, family-owned enterprises, entrepreneur and founder-led businesses, and where we can provide some of that governance framework and institutional controls if they are in any way lacking. I think the most important feature of this origination is absolutely essential. So proprietary sourcing does require, particularly in Europe, local presence, local offices. You have to understand that you are navigating distinct languages, cultures, and more importantly, we don't have a homogenous legal framework in Europe, so distinct legal frameworks, and so you have to have the jurisdictional expertise when it comes to underwriting and structuring around these assets. And I think probably the only thing I'll add there is to that extent, I think more important than origination is that structuring and restructuring expertise, because in the event that an asset doesn't perform in accordance with expectations, being able to ensure that you have structured the documents correctly, perfected the liens to be able to seize those assets and generate a very, very high recovery. And I'll say this as an example because my team, we are essentially restructuring. That is our background, our bread and butter of our business. And where we have, in some instances, been stepping into a distressed situation where the operating company debt, there may be an incumbent lender, is priced at 50 cents, so at a significant haircut, reflecting that the leverage profile of the business is no longer sustainable. If there is an asset-based lender that has the first priority ranking lien against their operating assets, you take them out at par and you take them out quickly, because otherwise you can't. I'll give you an example, an ice cream manufacturer in Spain. If there is a priority lender against those ice cream manufacturing equipment, you can't make ice cream without it. So you need to take them out at par as part of that homologation process. So I think origination extremely important, but structuring expertise incrementally important in terms of the return outcomes.
I agree. I think structuring is key. Origination is key. I mean, on the origination, maybe I'll just say that obviously we have a whole team out there originating. We do also, to the extent when there are situations where owning a platform really gives you particularly advantageous origination. Obviously, we do that as well. But I would say there's no one right answer. A mix of origination channels is really the best way to make sure that you're involved across the markets.
Yeah, I think that's been the observation for a lot of our members, is that in the asset-based space, there's kind of the self versus other originated business tends to fluctuate differently by jurisdiction, depending on, again, the structure of the market. In the US, there's a lot of managers actually having their own granular mortgage origination businesses, student loans, or car loan origination businesses, whether that's not the case at all in Europe, and you're going to have to be the partner with the banks.
The fragmentation in Europe, it makes it very difficult.
Right.
Non-bank lenders, if you start a non-bank lender in the US, the next day you lend to an addressable market of over 300 million people.
Right.
And in Europe, it's literally country by country.
But I guess how that partnership is structured is super important in terms of just
absolutely.
A great overview of an extremely diverse market. I guess the good news is that the growth and the capacity here are still far from being fulfilled. The bad news is that there's too much choice almost, and investors will have to think very carefully about how they want to approach this asset class. But I would contend that that is a really nice problem to have. So join me in thanking my panelists, and let's get ready for another session.
Thank you.